Joining us right now is Jason Pride. He is Glenmede's Chief of Investment Strategy and Research. And Jason, you'd think a lot of people would like to maybe sit back and relish what we've seen this year with gains, double-digit gains across the board for the major averages. But hey, this is the markets, and they're always looking forward. So what will 2026 bring?
Well, first, good morning and premature Happy New Year to both you, Becky, and Joe. As we look forward to the next year, yes, we can relish the gains from the previous year because they are thick across the board, independent of what asset class you're looking at, equities or fixed income. On average, balanced portfolios are up more than 10% for, and maybe even more solidly into the double-digit territory for 2025. So investors are feeling pretty good. As we look ahead to the coming year, number one, we think there's an acceleration that's going to occur in the economy because we are shifting from a fairly large headwind on tariffs to a smaller headwind on tariffs in 2026, and a significant amount of upfront fiscal stimulus coming from the One Big Beautiful Bill that'll feel a little bit like a bazooka for both the consumer and for businesses around tax season and throughout the year of 2026. But at the same time, we do need to look over our shoulders at some key risks. One of which, as you mentioned just a second ago, is haunting the Fed and the potential upside risk to inflation surrounding the magnitude of fiscal stimulus that we actually have in the pipe.
So you're looking at the potential risks, thinking that the signs are set for another good year. I think in the list of risks that you laid out, the one that jumped out the most to me was the AI spending that we've seen, particularly with data centers and expectations for chips that will be needed for those data centers. How do you read that? How do you prepare your portfolio for any potential risks there?
I think your read on our risks are right. The inflation risk in our perspective is the more likely, but more likely a smaller magnitude because the Fed will probably just adjust with their rate path and tamp that down a little bit. The AI risk is the one that we think is probably a lower likelihood for 2026, more likely a higher likelihood in 2027, but it really bears watching because there's uncertainty around that. What we're noting is that there's simply a lot of money being placed on the same spot on the board at the same time, right? There's a lot of money from the market's perspective. And then those companies that investors are putting their money in, whether they're fairly large tech companies or even in the private equity space, they're all pushing their chips in on the exact same item. And we've seen this playbook before, is when everybody bets on the same thing side by side, likelihood is there are probably going to be some winners, but there's also probably going to be some losers because not everybody can win when everybody is pushing in and doing the gold rush at the exact same time. The question is when that will occur. 2026, we think we probably still have a little bit of legs to it, but as we inch forward and more money is placed, the likelihood of that countdown to finally seeing some situations where people are not getting the return on investments they're expecting begins to become more likely.